The countdown for SpaceX is finally over. The market is processing $250 billion in orders, more than 3 times what it's looking to raise. At $135 a share, SpaceX enters the market with a $1.77 trillion valuation. That makes it the 8th largest company in the world the moment the first trade clears. To reach that scale, the company is earmarking 30% of the shares, amounting to $22.5 billion exclusively for individual buyers. This creates a sharp divide. Survey data shows 1 in 4 younger investors are rushing to buy on opening day, while seasoned analysts are questioning if the price is supported by the facts. The timeline is the first red flag. Tesla went public after 7 years as a private company. SpaceX remained private for 24 years. By staying private for over 2 decades, venture capitalists and early employees already captured the explosive value of the early-stage growth phase. At $135 a share, you are joining a 24-year-old enterprise that has already achieved global dominance. The high-risk ground floor phase ended years ago. This makes the 30% retail allocation look less like a wealth-sharing event and more like a tool for creating massive liquidity for early insiders. To find the truth, we have to look past the excitement of orbital launches and audit the SEC Form S-1, the official financial breakdown SpaceX filed to go public. Navigating this listing requires setting aside the Mars rhetoric to focus on the actual financial outcomes and trade-offs hidden in the data. The S-1 shows that SpaceX has evolved into a conglomerate split into 3 distinct segments: space, connectivity, and artificial intelligence. The space segment is currently the world leader in launch economics, with the Falcon 9 rocket commanding 82% of the global commercial market. But dominance doesn't equal profit. This segment generated $4.1 billion in revenue, but was entirely consumed by a massive research budget for the next-generation Starship. With the rocket business spending its revenue to develop new hardware, Starlink has become the financial engine keeping the parent company stable. In 2025, Starlink brought in $11.4 billion in revenue and delivered a $4.4 billion operating profit. This chart tracks Starlink's rapid expansion. The network now has 10.3 million active global subscribers, more than double where it sat just 1 year ago. But look at the second line. Average revenue per user dropped from $99 down to $66 a month. To find new customers in cities, SpaceX must lower prices to compete with existing fiber networks. They are trading profit margin for subscriber volume. As an investor, you get exposure to a scaled satellite network, but its future earnings are strictly limited by aggressive terrestrial competition. Starlink is profitable, but its $4.4 billion in earnings cannot carry a $1.77 trillion valuation on its own. The reason for that massive valuation is the third pillar of the company, the newly integrated xAI division. SpaceX now operates some of the largest AI compute clusters in the world, with over 200,000 GPUs and a gigawatt-scale data center. This waterfall chart shows the impact. The AI segment posted a $6.35 billion operating loss in 2025, which completely erases the profit from the Starlink business. When you combine all segments, SpaceX reported a consolidated net loss of $4.94 billion for full year 2025. Integrating xAI structurally shifts the company. It has moved from a profitable aerospace firm back into the profile of a cash-burning, early-stage technology startup. To see if $135 a share is fair, we must examine the price-to-sales multiple, the stock's cost relative to the revenue it generates. SpaceX enters the market at 94 times its revenue. For context, Nvidia trades at roughly 23 times sales, and Palantir at 67. SpaceX commands the highest premium on the board, while being the only company in this group losing billions of dollars a year. A 94 times revenue multiple leaves zero margin for error. Delays in Starship or a failure to monetize AI could cause that valuation to contract violently. Buying the stock right now means subsidizing a massive AI build-out while paying a price that assumes absolute perfection. Finally, we have to examine the structural mechanics of the shares themselves. The shares designated for the public are Class A stock, which carries very limited voting power compared to the shares held by the founder. Through this dual-class structure, Elon Musk retains 85% of the voting control. even while selling $75 billion worth of equity to the public. Retail investors provide the capital, but they cannot influence corporate decisions or challenge how that capital is spent on related party mergers. For those retail investors buying on day one, the most significant risk is the upcoming insider lockup expiration. Early employees and investors cannot sell immediately. Their lockup expires 180 days after the IPO, in December 2026. This creates a supply shock. Thousands of employees and banks will suddenly sell decades of equity, overwhelming demand and driving prices lower. Momentum traders might chase the opening day hype, but they are accepting extreme volatility and a high risk of being caught in a dangerous pricing bubble. Long-term believers in the mission have a safer path. Wait for the initial excitement to fade and the December supply shock to clear. For those who trade strictly on fundamentals, the stock remains a wait and see until the AI losses stabilize and Starlink proves it can withstand urban competition. SpaceX is undeniably a generation-defining infrastructure monopoly, but the retail float is a structural tool for insider liquidity. Waiting for the market to absorb that supply will likely prove more profitable than chasing the opening bell.